Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today we're diving into Nauticus Robotics, trading under the ticker KITT.
Nauticus Robotics is a high-risk, high-reward turnaround play, pivoting to a capital-light licensing model to monetize its proprietary Aquanaut autonomy technology. But its highly differentiated technological moat is currently overshadowed by a precarious financial position and reliance on continuous shareholder dilution to fund operations.
That sets the central conflict perfectly. You are basically looking at a tightrope walk between deepwater innovation and balance sheet reality.
Exactly.
So for this deep dive, we're analyzing this pretty complex turnaround story. We'll be dissecting the execution of its strategic shift, its core tech, and of course the critical financial hurdles it's facing.
And we're using recent Q3 2025 data and some key strategic announcements to do it.
It's a high-stakes race, and it feels like speed is everything here.
It really is.
Okay, so the first step in this turnaround story, it had to be immediate commercialization. KITT realized it couldn't survive as just a pure research and development shop.
Right, which is why we've seen them shift to this hybrid service and product model.
So how did they jumpstart operational revenue quickly enough to, just survive?
They executed a classic strategic move by acquiring a company called SeaTrepid. That deal was finalized back in March of 2025.
SeaTrepid. Okay.
And this acquisition was essentially their Trojan Horse. It immediately gave KITT an operational fleet, and maybe more critically, it gave them instant access to established master service agreements, MSAs.
And for our listeners, MSAs are those critical long-term contracts. The supermajor energy clients, the big contractors, they only give those to trusted, established players.
You can't just walk in and get one.
No, it's very hard to get your foot in the door.
Exactly. So SeaTrepid gave them that required trust, that infrastructure, and the revenue impact.
Yeah.
It was immediate and it was substantial.
Right.
This acquisition was the primary catalyst for that huge operational surge we saw in the third quarter of 2025. Service revenue grew a stunning 434% year over year.
434%. Wow.
Yeah, hitting $1.97 million. That shift proves the hybrid model can, generate immediate cash.
That growth looks great on paper, but the real long-term prize here isn't selling service hours, it's selling software. What milestone shows they can actually do that?
So the key event happened in mid-October 2025. That's when they got their critical technical validation.
Okay.
Their core autonomy software, which is called ToolKITT, it successfully completed a commercial operation, but not on their own hardware. It was on a third-party, remotely operated vehicle, an ROV.
And that's the real strategic pivot. If the software is platform agnostic, then it multiplies their addressable market instantly.
It does. That validation is key because it means they don't have to bear the massive capital cost of building hundreds of their own vehicles.
Right. They can just retrofit.
Exactly. They can potentially retrofit their software onto an existing legacy fleet, and that market is estimated to be over 300 vehicles. This is how you unlock high-margin software license fees from infrastructure that's already out there.
Okay, so we've seen how they used SeaTrepid to get their software out there on existing ROVs, but the real proprietary advantage is the hardware they designed from the ground up.
Yes.
Let's talk about the Aquanaut AUV itself. Why is this underwater drone their core technological moat?
Well, the Aquanaut is just fundamentally different from traditional vehicles. It's not a drone that just flies over targets. It's really designed as an untethered aquacopter.
An aquacopter. I like that.
Yeah, it means it has the stability and the maneuverability to hover, to perform station keeping, use sophisticated collision avoidance, and critically perform complex manipulations in tight spaces. They call that close quarters work, jogging.
So it's not restricted by that big umbilical cord dragging it around. It can work freely, which is, that's essential for true deepwater autonomy.
It is.
And how deep can this thing actually go right now?
The Aquanaut has already demonstrated capability at 2,300 meters depth. That was in qualification tests.
And to put that into context.
Well, that depth covers roughly 90% of the entire global offshore oil and gas fields. So if a job is out there, they can almost certainly access it.
That accessibility is powerful, but for the CFOs to sign off on a new contract, it's always an economic question. If the tech works, how does it translate into, meaningful disruptive savings for a customer?
The cost savings are generated pretty much entirely by the fact that the Aquanaut operates vesselless.
Vesselless.
You eliminate the need for a dedicated, expensive topside support vessel, it's basically a floating office building staffed with dozens of people just to run the drone.
And what are the hard numbers on that? What are we talking about per day?
Eliminating that vessel could reduce daily operational costs dramatically. The company quantifies it as anywhere from $20,000 up to $150,000 per day.
Wow. Think about a month of savings on a big deep water project with those figures. And those savings, they also align perfectly with environmental mandates, which is becoming crucial for the supermajors.
Exactly. That same vessel elimination provides a major sustainability benefit. You're cutting carbon emissions from the operation by an estimated 70 to 90%.
A huge number.
It's a compelling dual proposition. Cut costs and cut carbon.
This brings us squarely to that strategic pivot, the move toward a truly capital-light model. When you have high operational costs and a finite cash runway, you have to stop selling metal and start selling intelligence.
That's the only way forward.
So how are they shifting away from that capital-intensive manufacturing?
They're strategically outsourcing the heavy lifting. The most important example is the partnership with Forum Energy Technologies, or FET, that they announced in December 2025.
Forum Energy Technology. Okay.
This agreement shifts all the heavy capital expenditure and the complex manufacturing requirements for their fully electric manipulator arm, the Olympic arm. It shifts it all onto FET.
That sounds like a really smart de-risking move. They keep the intellectual property, they kept the software revenue stream, but they externalize the production risk.
That's it. So the ultimate goal here is pure high-margin software licensing.
And what kind of gross margins are they projecting for that intelligence?
Management has made it very clear that the key margin driver is the ToolKITT Autonomy software. They expect it to carry ultra-high margins. Specifically, they're estimating 80% plus gross margins.
80% plus. That's where the profitability is.
That is where profitability lives, yes.
So if we look at the whole strategy, the SeaTrepid deal, the FET partnership,
Wow.
It all serves one purpose,
Okay.
maximizing that 80% margin.
Absolutely. The entire strategy is designed to accelerate the deployment of the hardware, the Aquanauts and the Olympic arms, by third parties. Every one of those devices expands the install base for the ToolKITT software, and that increases that recurring high-margin revenue base.
It's a classic platform model, just adapted for the deep sea.
Pretty much.
All right, all this talk of 80% software margins sounds fantastic, but we have to look at the immediate reality, their current financial position. That promise is heavily overshadowed by some severe liquidity constraints right now.
This is the central risk of the whole thesis.
Let's dig into those Q3 2025 financials.
Okay, the Q3 metrics, they reveal a severe cash burn problem. The company reported a net loss of $6.6 million.
$6.6 million.
Now, contrast that against the service revenue we just praised, a mere $1.97 million. And on top of that, their reported gross margins were deeply, deeply negative.
A negative.
Coming in at minus 426.7%. That is a massive operational gulf.
Negative gross margins. So for every dollar of service they sell, they're losing more than $4 just to deliver it. That just speaks to how early they are in this whole commercialization process.
It does. It's a huge burn.
Given that burn, how long is their immediate cash runway?
It's extremely limited. KITT held only $5.5 million in cash as of the end of Q3 2025. That runway, it necessitates continuous aggressive financing just to keep the doors open.
Just to buy time.
To buy time until those high-margin contracts can hopefully stabilize the balance sheet.
So what financial tools are they using to bridge that enormous gap?
Well, the primary tool is the at-the-market stock offering, the ATM. This is essentially selling new shares, bit by bit, into the open market, sometimes daily. It's why we're seeing continuous shareholder dilution.
And they have a credit line, too.
They do. They secured a massive $250 million equity line of credit, the ELOC, though management has publicly stated they will only tap that for immediately accretive cash flow generating acquisitions, not for R&D or just funding operations.
That level of financial maneuvering has to have direct regulatory consequences. They're facing a Nasdaq compliance issue, right?
That's right. It's a serious risk. KITT received a delisting notification for failing to meet two critical requirements: the $35 million market value of listed securities, or MVLS, and the $2.5 million shareholder equity minimum.
And failing those can get you kicked off the exchange.
It can.
So how are they planning to stay listed and regain compliance, especially when they need cash so badly?
They're relying very heavily on strategic financial engineering. To boost shareholder equity, at least on paper, they've been using debt-to-equity conversions. For instance, converting $3.7 million of debt back in October 2025. And to manage the minimum $1 share price, they've resorted to some pretty extreme measures.
The reverse splits.
2 recent reverse stock splits, a 1 for 36 and then a subsequent 1 for 9.
And just for our listeners, a reverse split shrinks the number of shares to artificially boost the price, but it often reflects severe underlying financial distress, and, well, it inflicts huge pain on existing shareholders through massive dilution.
It's brutal. So NASDAQ compliance, for the moment, is critically tied to their ability to just keep executing these ongoing financial maneuvers. They're just buying time until the commercial strategy pays off.
Okay, let's bring this to a final synthesis. KITT is in this high-stakes race against dilution and cash burn. What are the 3 biggest constraints that could derail this turnaround, even if demand is strong?
First, they're experiencing asset scarcity. Management directly says they have more demand than we have ROVs. They just don't have enough physical hardware to meet the contract needs.
And you can't license software to hardware that hasn't been built yet.
Precisely. And that leads directly to the second constraint. Supply chain delays. Building more Aquanauts is slow. You have long lead times for specialized components, often taking 6 to 9 months.
A serious bottleneck.
A huge bottleneck, restricting their ability to convert that demand into revenue.
And the third hurdle must be the human element. We see this in every disruptive industry. Overcoming the inertia of, conservative customers.
Absolutely. The third constraint is cultural change. They face the difficulty of overcoming the skepticism of conservative energy operators for widespread vesselless adoption. These are people who've used the same expensive traditional methods for decades.
It's a massive leap of faith, even with those cost savings on the table.
It really is.
So what does this all mean for the thesis? It all comes back to speed and execution.
It does. KITT is in a high-stakes race to achieve profitable, high-margin software revenue in 2026 before that continuous shareholder dilution and that severe cash burn just become unsustainable. It could turn all this potential for technological triumph into a financial tragedy. And that leaves you with a final thought to consider. Given the extreme reliance on financial engineering constant stock dilution, debt-to-equity conversions, just to support operations, does revolutionary deepwater technology need to fundamentally rethink its capital structure? Or is this volatile path simply the inevitable cost of disrupting a multi-trillion-dollar industry?
Risk defined. Portfolio protected.